Let's talk about loans that require the least amount of money down. The loan that's always been there, we've done for a long time, is a Fannie Mae, Freddie Mac kind of loan that requires you to put down 5%. That 5%'s got to be your own money. If you're buying the house, it has to be your 5%. Can't get that 5% somewhere else. You have to have earned that 5%. Downside is in today's market, if you're going to put down 5%, that means you have to have mortgage insurance, and the downside is you have to have a pretty high credit score to get mortgage insurance. That typically means a 720 or better credit score. So that kicks a lot of people out. And also, the property that you pick can't be in a declining market, which a lot of the country is. So we've gone to doing a lot of FHA loans. Why FHA? FHA, you only have to have 3.5% down. That 3.5% can be your 3.5%. It can be from a relative. It can be from your employer. Come from a lot of places to help you get in the house. So it's less money down. Plus, on credit score on FHA, you can have a score as low as 620. So a lot more people qualify for FHA than they do for the Fannie Mae loan. And actually, in a lot of cases, it's a lot better deal. So that's the two main loans we're doing. There's also another loan called a Rural Development Loan, or a USDA loan. In order to qualify for a USDA loan, you have to be in a rural area. That typically is something like north of Cherokee County or north, Forsyth County or north. It goes by zip codes. So what we have to do is find out where it is you're looking, put it in the computer, and see if you qualify for that area. If you do, you get a 100% loan. The rate's a little bit higher than FHA or Fannie Mae, but if putting money down is a big issue to you, you want to look into a rural development loan if you're moving in the outskirts or out in the rural areas of Metro Atlanta. The other thing that you need to consider is that the Obama administration has come in during the stimulus package and offered $8,000 to first-time home buyers. So if this is the first time you've bought a house, typically that means in the last 3 years. Well, let's just say it's first time. They're not clear on that. But if this is the first time that you've bought a house, and you make under $75,000 a year, or you and your spouse make under $150,000 a year, you could qualify to get up to $8,000 in tax credit. That means they're going to write you a check. So if you went to pay your taxes next year and you didn't owe the government anything, and you put that and you bought a house this year, they're going to send you back a check for $8,000. Well, guess what? You could go to your mom or dad or grandmother, borrow the down payment money, get in an FHA loan because they can gift it to you, or they can gift you the money, get into an FHA loan, and then if you wanted to, when you got your tax credit back, you could gift it back to them if you wanted to. Don't have to, but it's available to you. So if you haven't thought about buying a house, or if down payment money is a consideration, a lot of options right now to help you out. Please always, if you have any questions, don't hesitate to give us a call. Thank you.